So I have an amazing guest with me today, and Callum Thomas, you are the founder of Topdown Charts, which is a chart-driven research house covering global asset allocation and economics, and you have backgrounds in multi-asset strategies on the buy side. It's a real pleasure to have you here, and we're going to have a great conversation evolving around a lot of your views that you've personally written upon in Top-Down Charts, and some of the outlook going to the new year of 2021. So Callum, thank you for coming.
Yeah, pleasure to be here. Looking forward to it.
Great. So first of all, I really wanted to understand better, for the viewers at least. You're operating out of New Zealand, is that right?
Yep, exactly. Yep. Born here. Briefly went across to Australia for a bit when I got it promoted across to there, and then came back. Decided to basically start my own company. I'd been working in big corporate land for a while, and I had sort of a bunch of seeds sort of begin to get planted. It's often how these things happen. If you're looking from the outside, you're kind of watching the thing, and then it's like, oh, he's just made that decision all of a sudden. But often when somebody makes a big decision, there's a number of seeds that have been planted along the way that have just been sort of progressively germinating across time, and it certainly was the case for me. And it came as a shock to a lot of my colleagues, but to me, it was like, well, isn't it obvious? So yeah, I mean, that was just almost 5 years ago now. Basically, I think I always had a bit of an entrepreneurial itch that I needed to scratch, and being on the buy side, I think there is this decision that you need to make at some point, or that may be sort of forced upon you, or maybe it's even a non-decision for some people. But on the buy side, you're basically, if you're front office involved in actual investments, you're either doing research or you're doing portfolio management. Obviously, there's a lot of people that do both of those, but you can pretty much choose to basically specialize in one of those kind of paths. And I sort of began to go down the research path. So it's kind of logical that I'd end up in this kind of situation. But I think that's also a point sort of worth thinking about too, is just the difference between research and portfolio management. I mean, on the research side of things, your job is to go out and find out enough stuff to be able to have a high enough conviction opinion on a differentiated enough idea to give the portfolio manager something to go on. Whereas the portfolio manager, it's it's about filtering those ideas, but it's also about more about risk management. I guess carrying that idea from inception through to its end, which may be either, oh, that's actually a bad idea, so let's risk manage it out, or it's a good idea, so what do we do with that there from now?
Yeah, it's very interesting, and it's extremely admirable that you essentially juxtaposed all of your talents, from the buy side, from the street, from actual research, from your own skills of your own research. You combined everything and you did things your own way. So that's extremely admirable. It's great to hear. And also, and that's what I really want to get into today is, because you wrote a recent article on Top-Down Charts that was titled 10 Charts to Watch in 2021. By the way, we're going to have all of your information at the link below in the description of the video. So anybody that wants to see your work, your research, they could do so with an easy click of the button. But anyways, the first question about your article is, well, first of all, it said in the article that you're expecting continued weakness in the US dollar. I believe the DXY in the year of 2020, it retraced to the downside around 10, 12%. some people kind of overdid it and said, wow, so the dollar is really crashing. We're here. It's happening right now. The inflation bugs are here. They're popping.
Yeah.
So there's kind of two sides to the story. And which
Mhm.
side of the story should people really, be considering in terms of, whether it's playing defensively or being conservative, whatever it may be?
Yeah, I mean, the US dollar is probably a good point to start at, because it is one of those markets that is, it is an opportunity in and of itself. It's something that you can take an actual active position in, you know, itself, either the DXY or any other index or peer. But it also has pretty substantial implications for a lot of other asset classes, because you know, I mean, just one simple example is commodities. A lot of commodities are priced in US dollars. So therefore, if the US dollar weakens, then, all else equal, the price of those commodities is going to go up. Also has pretty big implications for financial conditions for emerging markets, um, and, you know, really impacts a lot of the sort of global flows dynamics as well. So I think with the US dollar, there is a bit of nuance in the outlook. So short term, there has been pretty significant shift in investor sentiment for the US dollar. I mean, yeah, you just said that kind of retracement in price is always going to drive a big shift in sentiment. And I think looking at sentiment, price, all these sort of tactical indicators can be very valuable. And I think yeah, sentiment does have particular information, but then, when price moves that way, it does do a lot to shift sentiment and also positioning. I mean, there's a decent pool of capital that basically will look at movements in markets and say, okay, that's ticked the box of my quantitative criteria, so therefore we're going to go and jump on that trend. So the momentum traders, CTAs, etc. But in terms of the short-term outlook, you've had sentiment swing from basically crowded bulls late this time last year, to now crowded bears. I think it's become quite a consensus trade. It's always easier to say bearish US dollar or bearish whatever it is if it's going down, um, you know, because then it's sort of like, well, everybody can see it's going down, and it's a little bit easier to explain, and there tends to be a little bit less resistance to the idea, versus if it was sort of still going up, or still in the peaking process. So sentiment on positioning. So I look at speculative futures positioning. So it's the non-commercial traders in the CFTC data sets, commitment of traders. And that again went from crowded longs to now crowded shorts. And then also just looking at technicals. So I took a little bit of a different approach to looking at technicals for the US dollar index. I used what we call market breadth indicators. So probably most people are familiar with stock market breadth, so number of stocks that are above or below their 50-day moving average, and that can be quite a useful oscillator for generating overbought, oversold signals or divergences as well. So the breadth indicator for US dollar is, as you might guess, completely washed out and looking basically, oversold. Um, you know, well, I guess I'll just round out the final point there. The final point is that the US dollar index itself is sitting at a bit of a key intermediate support level there. And so, you know, if you're just looking at short-term sort of ideas and you see this market that's crowded bears, crowded shorts, looking oversold, sitting at a key support level, you'd think, oh, that could be something that's, had a decent probability of bouncing, maybe a short squeeze. So I think basically what I'm trying to say is that the short-term picture is, it's a pretty good chance that we see a bounce. Now, the caveat to that, just to round it out, is that when you get major trend changes, you tend to pay a little bit less attention to sentiment. So if you're in a range, you'd be paying massive amounts of attention to sentiment, positioning, technicals, because you expect it to continue in that range. But if you're at a turning point, the market can stay oversold. The consensus can be bearish and right. Sometimes the consensus is right. Sometimes the crowd is right, particularly at the start of big moves and through the range. The crowd tends to be more wrong at the turning points. And so we've already sort of gone through that. The crowd was wrong, last year when it was crowded to the long side. So that's sort of how I'm thinking about the short term. And I guess to spoil my medium term view is if I see this short term bounce, this short term rally, I would consider that, unless something material has changed, I consider that to be a short squeeze, something to fade, something to double down onto the bearish call. Because if you think about the medium term perspective, there's a couple of things that continue to bias my view to the downside there. So one is just the fact that we tend to have these big long term sort of 10 to 15 year cycles in the US dollar. Looks like one of those cycles is just completed and we're going into the next cycle, which is the down phase. So, and then the other one is looking at valuations. So my composite valuation for US dollar index has gone from basically, not super expensive, but the most expensive since the previous major bull market. It's gone from expensive down to neutral. Now, usually with currencies, with valuation metrics with currencies, you don't usually tend to see it go from overvalued down to neutral. You tend to see it overshoot. And so expecting that overshoot also helps bias that medium-term view to the downside. And I mean, not to sort of overthink it or try and get into circles too much, but if that valuation indicator had gone down into cheap territory, then I would be talking a very different tone.
Right.
But the other thing is, also the fiscal outlook. US dollar index tends to follow the budget deficit, and so that's creating a bit of downside risk there. And then also yield support. So yield support was actually pretty substantial, into 2019, but that's completely evaporated now. It's sort of neutralized, as a bear on the US dollar, a tactical medium-term sort of bear, I would say that I'd like to see the yield support dissipate a little bit more, but just the fact that it has dissipated and turned does kind of support that medium-term view. So sitting here with a bearish medium-term view is a key reason why I wouldn't want to go against sort of my core view and try and chase or speculate or bet on a short-term bounce, even if the odds do look kind of decent. So yeah, to round it out or to sum it up, every possibility that we do see a bounce, a short squeeze in the short term, but that's likely just a little bump on the road as we continue that path downwards over the next, I would say, at least a couple of years.
Okay. Very interesting. So with keeping in mind the fact that what we've seen at least recently the past week or so, short-term rates have been inching higher above that 1% kind of threshold on the 10-year. But then you have inflation expectations also. I think the Michigan survey or something was at 3% from 2.5%. So people are taking that as a pretty big deal. And in fact, we saw mortgage applications, everybody just piling in because, rates are kind of creeping up per se. So what's your response to that? How is your thinking evolved around that? Is it just a temporary kind of move higher, or are we going to see rates potentially normalize? Well, if the Fed decides to normalize their balance sheet.
Yeah, a lot to talk about there. I guess maybe we start with inflation. So I think people are starting to come around to the idea that, inflation risks are basically one direction at this point. Last year, the theme was kind of deflation. And certainly we saw, CPI deflation economic deflation, commodity price deflation very briefly. But going to this year, I mean, the theme is, I mean, it just looks almost too obvious to me. It's like you've got these short-term factors that are going to put upward pressure on pricing. So a lot of backlogs, inventory issues globally. All the supply chain disruption from the pandemic has resulted in, pretty significant backlogs at factories. So, usually you get backlogs through one of two ways. Is either, demand's really swung up a lot faster than factories expected, or demand's, decent, but then there's been some issue, whether it's a natural disaster, global pandemic, that's kind of stopped them from being able to produce. And I mean, if your country goes into lockdown and your staff aren't allowed to go to the factory, then you're not going to be making things. A little bit different from us, office workers who can just keep on working away. So clearing of those backlogs and just the short-term impact of that, because if demand stays the same but supply is sort of a little bit curtailed or delayed, even that can tend to put a bit of upward pressure on pricing. But then also just on the other side of that is that as you clear those backlogs, that's going to put a bit of a kicker behind activity, because there's going to be this sort of that flurry of activity to get on top of that. But aside from that, you've got really historic amount of fiscal monetary stimulus churning through the system. Looks like we're going to see more fiscal stimulus this year, certainly in the States, and but also Europe and Japan have got pretty substantial packages set to go this year. I think one interesting point to note in passing is just how there is a lot of emphasis, at least in Europe and Japan, on trying to do stuff that's going to be, fiscally, that's going to be not just providing a short-term sugar hit, but trying to do sort of economic transformation initiatives. So, I mean, that's definitely very interesting. It's the kind of thing that, could kick off multi-year growth upside. And so I guess the point there is that there is this risk that the economy ends up overstimulated. And then aside from that, pretty important one too is just the kick up in commodities that we've seen pretty broad-based strength in commodities. One area I've been paying a lot of attention to is agricultural commodities. And so, grain prices have spiked substantially. And, if you'll get further follow through on that, which I think is entirely possible, that will put a bit of a fire under food price inflation. And, that is only headline inflation, but, if you get a sharp enough increase in headline inflation, then that can actually tend to sort of ripple through to actually core inflation as well. And then even just in the short term, base effects are always something worth highlighting. If you look at crude oil, the crash last year was in March, April, also the height of the crash. And so just by virtue of mathematics, the fact that oil's sort of more normal now, the percentage changes are going to be near astronomical. And headline CPI tends to follow year-over-year change in crude oil. So we'll probably see a bit of a tick up in headline CPI year-over-year figures just because of those base effects. And that should be no surprise. And, everyone should expect that. But then, there is the risk that you do get that sort of headline sticker shock impact, and that with all these other things that are going on, sort of provides a bit of a further kick to inflation expectations, which indeed have been trending up pretty sharply. And then I guess how does that flow on to the Fed? Well, I think it seems to me pretty clear that we don't get any further easing from here unless things really deteriorate. We're probably going to get more fiscal, and what that's going to do is take the pressure off the Fed. So, I think rightly so, the conversation is starting to at least discuss the idea of Fed tapering or stimulus exit. It is a topic for later on, but as inflation starts to show up more and more, that conversation is going to become, more of a what do we got to do about this rather than here's something that's on the horizon. So, and then how does that play into bond yields? Well, obviously, if you expect that the Fed's not going to be doing any more easing, then at the margin that takes away one argument for being bullish bonds. And then, if you take that a step further and say, oh, the Fed's probably going to have to do something about at least tapering, if not exiting. I think exiting or tightening is, a conversation for quite a bit later. But the tapering process, as we saw in 2013, can be quite, a source of volatility and surprise to markets. So definitely something on the radar. In terms of bond yields, I think 10-year goes higher from here. I think that breaking above 10, that 1% mark is pretty key just from a technical standpoint. But I look at about almost a dozen different macro market indicators, and they're all pointing to higher bond yields. Some of them saying 2 to 3%, some of them saying the high ones. The consensus across these macro market indicators is higher. And I think that, the only reason that we haven't gone higher sooner is just, some of those sort of event risks that were on the horizon late last year, now all largely behind us. Also just seeing a little bit more whites of the eyes in terms of the actual progression of the economic cycle. So the PMI is clearly recovering now, and I guess the emerging signs of inflation, but also Fed policy, but also fiscal policy, because the more fiscal they do, then the more borrowing they have to do, and then just from a flow supply demand perspective, that also feeds into the mix. I guess the sort of to play devil's advocate against myself for a little bit would be, the Fed's not going to let bond yields go up too high because they'll just do yield curve control or yield caps or more quantitative easing. And my response to that is basically, it really depends on the nature of the move. So if it's a really fast and substantial move, then maybe the Fed does step in and do something. So if you got, say, 100 basis points across 5 days, that would be very different versus, say, 100 basis points across 5 weeks, or, sort of a longer drawn out period. And also what's actually driving it. If it's some sort of market disruption, some sort of artificial thing, then Fed's more inclined to act. If it's reflecting actual improved growth and inflation outcomes, outlook, then, the Fed probably just says, oh, yeah, that they're just doing what they're supposed to be doing. So, yeah, I mean, it's pretty hard. I can't really think of any compelling argument to be bullish on bonds or to expect that yields would go lower unless, you had a very grim view on the economy, which I think is just hard to justify. Yeah, and then overlay against all that too, the fact that on my measures, treasuries look extremely expensive. So, yeah, I mean, I wouldn't be sitting here saying that bonds are going to crash and that yields are going to go to 3%, but they'll head towards that direction. And yeah, so I think higher yields are probably here to stay. Probably we're going to see more of that. Yeah, go and get that mortgage set.
So with that being said, when is gold going to $10,000 an ounce? No, I'm just kidding.
Not this cycle. I'm bearish gold.
So
which is a bit out of consensus, but well, yeah, that's right.
Are you bearish or temporarily bearish, or is it part of a cycle move, or what's your thinking behind golds in particular?
Yeah, I think that one of the key arguments behind gold's rally last year was the Fed doing all this quantitative easing, all this easing, and I've just, I think, laid out a fairly compelling case that the Fed doesn't do any more easing. So as a minimum, that takes a tailwind away. And then if you get fiscal driven expansion, that improves risk sentiment, which again, there's a certain element of risk premium in that rally of gold. So you take that out. And then there's the real yield aspect. So real yields are likely to head higher as a result of increased fiscal stimulus. I think you potentially could push back on that a little bit by saying that, most of the move in nominal yields is going to be inflation expectations driven. I think that they should at least keep pace with one another. So I think that real yields don't go any lower this time around. But my core view is that real yields go higher because real yields basically reflect risk sentiment and growth expectations, which should both improve. So you get higher real yields, that puts an actual headwind for gold. So I think that this cycle, gold probably struggles to go any higher. Maybe it gets a little bit of a kick from weaker US dollar. But I would say best case scenario for gold is ranging. But then, you look at where sentiment positioning is on gold, and, all those traders who piled into gold could get a little bit disappointed by that and figure, screw this, let's go and look for better opportunities elsewhere and
Right.
put it under selling pressure.
Right. I think there will always be a demand side for gold personally, because you will always have people who use it as money, who buy it not to sell it, but they buy it to hold it, to use it as what a commodity is used for use value, and for I'm forgetting the other kind of value, but it has two kinds of values, one that you could use and one that you could actually consume. And gold, you could do both of those. Bitcoin, you can't, I would argue, but that's a whole nother episode. Callum Thomas.
That's outside of my wheelhouse. Sorry.
So Callum Thomas, again, thank you so much for coming on. And would you like to, for yourself, tell the viewers, I know I mentioned it earlier, but would you like to, mention any more information on, where our viewers could reach you and read more about your research?
Yeah. The best way is to follow on social media. If you work as a portfolio manager, or you've got an investment business, then definitely get in touch. I basically only work with institutional investors, but I still do plenty on social. So, if you're not in that space at the moment, then definitely get in touch on social.
Great, excellent. Callum Thomas, everyone, thank you very much.
Thanks.